All right, let's get right into it. We're in the middle of the largest wealth transfer in human history. But here's the thing, this isn't a simple story about kids inheriting money. The real story, the one that matters, is how the very definition of wealth is being fundamentally rewritten as we speak.
I mean, the scale here is just mind-boggling. Cerulli and Associates just updated their forecast. We're now looking at $124 trillion. That's what's expected to change hands by 2048. This is not a slow drip. It's a tidal wave of capital about to be unleashed.
And that forces us to ask a really critical, kind of contrarian question. What if that number, as massive as it is actually the least important part of the story? What if it's just a distraction from a much deeper, more systemic shift in power, in strategy, and in the very assets that are going to define wealth for the next 50 years? Right. So this is where the big misconception comes in. This is not just an inheritance story. It's about the total collapse of the 20th century financial playbook. And, it's about the rise of a completely new one that's built for a world of sticky inflation and digitally native capital. For literally decades, the 60-40 portfolio, 60% stocks, 40% bonds, that was the foundation of boomer wealth. It was safe, it was reliable. Well, in 2026, that model is a death trap, plain and simple. Structural inflation and the fact that stocks and bonds now move together means that the old safety net now basically guarantees your wealth gets smaller in real terms. And check out this quote from JP Morgan's team. It really nails a key point here. All the passive, automated strategies, the robo-advisors, the index funds, they're great when things are going straight up, but they cannot handle the kind of inflection points we're living through right now. The old just buy the dip mentality is completely broken for this new economic world. So if the old way is broken, where is the smart capital actually going? Well, the first pillar of this new playbook is what we call the tokenization revolution. We've moved way beyond speculative crypto coins. We're now talking about digitizing tangible, real, income-producing assets. So what are we actually talking about? Real-world assets, or RWAs. Think about things like skyscrapers, big portfolios of private credit, entire energy grids. What's happening is that blockchain technology is being used to convert these assets, which are normally super illiquid, into digital tokens that you can buy and sell with incredible efficiency. So let me just break down how this works. Say you have a billion-dollar skyscraper. Its value gets digitally chopped up into millions of tiny pieces, or tokens. These tokens, which represent direct ownership, are then secured on a blockchain. And then investors like you can buy and sell these shares on a market 24/7. It creates instant liquidity for an asset that used to be locked up for a decade.
And what's really fascinating is how sophisticated these new structures are becoming. This isn't just about owning a piece of a building anymore. You can buy debt tokens that act like a bond, paying you a fixed, predictable income, or you can get into hybrid structures that give you a base return plus a piece of the upside. It's a complete unbundling of the old investment model.
And look, this is not some tiny niche thing. Projections are showing the global market for this kind of fractional ownership hitting over $21 billion by 2027. And guess who's driving this? It's almost entirely millennial and Gen Z investors who are demanding the kind of access and liquidity the old system just could not deliver. Okay, so that's the digital side of things. But now let's pivot to the second pillar of the 2026 playbook. And what's interesting is, it isn't digital at all. In fact, it's intensely physical, and it's been hiding in plain sight this whole time. We all think of AI as this virtual thing that just exists in the cloud, right? It's just software. But that is a really dangerous misconception. The AI supercycle we're in right now is, at its core, a story about physical, real-world constraints. Exactly. AI is a physical beast. It runs on a frankly insane amount of electricity. It needs a massive, and I mean massive, build-out of data centers, new power generation, and grid infrastructure. All of these physical needs create these anti-fragile investment opportunities that have absolutely nothing to do with the hype around AI software stocks. And if you want to know where the real smart money is going, just follow the private equity giants. Blackstone isn't just buying data centers anymore. They're buying the companies that make up the electrical supply chain for them. Brookfield has over $1 trillion in assets pointed at this space. KKR's got a $50 billion partnership just to build out the physical backbone of the AI economy. They are buying the picks and shovels for this digital gold rush. So the crucial point is this. ESG investing, it's moved from being just a nice, ethical thing to do to being a systemic necessity. In this new, power hungry AI economy, green and resilient infrastructure isn't just good, it's actually the most critical, non correlated, and inflation proof asset class you can possibly own. So, this new world, it really forces a choice. It creates this fundamental divide, not just in strategy, but in mindset. You're either a passive recipient of an old portfolio, just kind of hoping for the best, or you're an active survivor, adapting to this new reality. What we're seeing is a clear K-shaped split. On that upper arm of the K, you've got the people who get these systemic shifts and are actively moving their capital. And on the lower arm, you've got people who are just passively holding onto their parents' assets, basically just watching inflation eat away at their real value year after year. And this chart just lays out the two mindsets perfectly. The passive recipient? They're still clinging to that obsolete 60-40 model. They're focused on nominal returns while inflation is just silently destroying their buying power. The active survivor, on the other hand, they've adopted a modern portfolio. They're integrating alternatives like private credit and infrastructure to generate real returns. They know that 81% of their generation fires their parents' financial advisor for a very good reason. And look, don't just take our word for it. The data is undeniable. A backtest running from 2015 to 2024 shows that a modern portfolio, one that's enhanced with just a 20% slice of alternatives, delivered significantly higher risk-adjusted returns, that's the Sharpe ratio, and had a much smaller drop during downturns compared to the old 60-40. And this is what that resilient portfolio looks like. See, it's not some radical reinvention. It's a strategic evolution. You still have a core of growth and income, but you add this crucial 20% sleeve of alternatives. And that provides the diversification and inflation protection that public markets on their own just can't give you anymore. So all of this leads to a very direct and frankly urgent challenge. The rules of the game have changed. Clinging to the old playbook isn't just a bad strategy, it's not a viable strategy at all. I want you to let this image sink in. In a world with 3 to 5% structural inflation, any wealth that isn't actively working for you, it's a melting ice cube. Doing nothing is an active decision to let your purchasing power just evaporate into thin air. So adaptation isn't optional anymore, it is mandatory for survival. And the very first step is committing to this new way of thinking. So this is your invitation to join the Survivor Circle. It's a community that's focused on staying rational and strategic when all the market volatility makes everyone else panic. Because at the end of the day, the goal isn't just to muddle through this massive shift. The goal is to survive today so you have the capital and the mindset to thrive tomorrow.